Before the ETF boom, the assets under management were able to explain 1% of the price variations in the S&P 500. After their boom, their price is almost completely explained by the growth of the assets under management of the ETFs. The role in this presentation, I'm going to defend my final degree thesis titled Market Homogenization and Systemic Risk, a critical analysis of exchange-traded fund proliferation. Over the past 2 decades, ETFs have completely grown exponentially to the point that they represent almost $15 trillion of assets under management, with a great concentration in the American market. This raises the following question. Does the proliferation of exchange-traded funds undermine financial stability? In order to analyze the impact of ETF proliferation, I focused my thesis around the following arguments: the capital misallocation, the distortion in the price discovery, making the index stocks overvalued while the non-index peers undervalued. Furthermore, it encourages herd behavior, which amplifies the impact on market valuations via the inelasticity hypothesis. This new financial situation presents novel systemic risks. To understand these effects, I drew on a few key concepts, such as that passive investing reduces the capital engaged in fundamental analysis. Furthermore, the Inelastic Market Hypothesis has a disproportionate large impact on prices, and as we'll see in a second, index tracking leads to correlated trading. My methodology combines looking at the ETF growth with some fundamental analysis for the broader market, followed by a regression that proves our point, and finally, we'll be looking at some individual case studies with how ETF outflows completely affect the pricing and the valuation of the market. Before the ETF boom, the assets under management were able to explain 1% of the price variations in the S&P 500. After their boom, their price is almost completely explained by the growth of the assets under management of the ETFs. This is further highlighted by the disconnection between the fundamentals. Right now, the dividend yield is 34% lower than the average for the last 20 years, and the cyclically adjusted P ratio is 42% higher than the mean for the last 20 years, which means that investors are willing to pay a higher price for a lower expected return. Let's take a look at some individual companies that further prove this overvaluation. The first one's Apple. In order for Apple to justify their share price in 2024, they would need to grow their free cash flow for the next 10 years at a 16% growth rate per year. Their real growth for the last 4 years has been 7.17%. Moreover, Tesla should grow their free cash flow at a 52% growth rate per year in order to justify their current share price. Using their real growth rate, the company looks extremely overvalued. And if we take a look at MicroStrategy, which basically is a company that borrows money in order to buy Bitcoin, they haven't had a positive fiscal year since 2019. Their underlying business is just losing money. If we take a base case scenario in which there's a 40% outflow of ETFs from the United States, by applying the inefficient market hypothesis, the S&P 500 will lose around 21 trillion of market cap, which would lead to a 42% drop in the US market. But this effect would extend to the global markets, as the US equities make around 64% of this all-country world index, and this would lead to a decrease of 30% of the global market cap. Therefore, we can indeed say that these passive flows lead to market homogenization and distort valuations, especially as we saw for large cap stocks. These mechanics encourage herd behavior, and the inelasticity works both ways. It amplifies the impact of inflows, but also of the outflows. Furthermore, there's this recent study in which Laritz and Verkler discovered that the average individual investor only spends 6 minutes on research per every trade that he or she does. And of these 6 minutes, 70% is to look at price movements instead of actually looking at the fundamentals of the company. The conclusion is that the ETF growth combined with the market inelasticity is fostering an environment of systemic risk. Paradoxically, this creates potential inefficiencies for active fundamental value investors. There's obviously some limitations to our model, especially the fact that we're using a static multiplier effect, and the market is much more complex and dynamic than that. Nevertheless, for future research, I would like to include some binary variables in the regression model. I think coupling this with the fundamental metrics we've used will lead to an even more accurate predictor for future S&P 500 prices. Also, for this research, I feel it would be super interesting to focus on a more behavioral perspective that would give us much more insights in the rise of these ETF flows and also on the outflows. And finally, the most challenging one, I think it would be to develop a regulatory framework for ETFs. Just to finish, I would like to use a quote from the great Charlie Munger, which is, "Show me your incentive and I'll show you the outcome." ETFs were once a great way for investors and non-investors that wanted to achieve the average total return of the market of 10% without having to actually study all the fundamentals of the business. However, these positive incentives have led people to overpay for the same companies while hoping to achieve this 10% of average return. And so far it's working because the inflows are coming in and everyone is getting their desired 10%. However, the reason the people 20 years ago were getting this 10% was because the companies were much cheaper. So the question is, what will happen when these inflows stop coming in? For now, I guess we'll have to wait. Thank you for watching and have a great day.